Annuities. You've probably heard of them. They make this big promise of market-linked growth, but with downside protection. So how do they actually do that? How do they work? Today, we're going to lift the hood on these, let's be honest, kind of complex financial products and see exactly how they generate returns. That way you can really understand the trade-offs involved.
I mean, this is the big question, right? It's the classic dilemma every saver faces. You want the kind of growth you can get from the stock market, but there's no way you can afford to lose your hard-earned savings if things go south. So how do you bridge that gap? Well, a certain type of annuity was designed to try and answer that very question. The first thing you've got to know is that annuity isn't just one thing. It's really a whole family of products, and each one is designed for a slightly different goal. So let's take a look at the four main paths to growth that they offer. Okay, so this table pretty much lays out the entire landscape for us. On the far end, you have the super simple fixed annuity, or MYGA. Just think of it like a CD from an insurance company. You get a declared interest rate, and there's no market risk. Then there's the fixed indexed annuity, which is going to be our main focus today. It uses a market index like the S&P 500 to get growth, but it still protects your principal. A RILA, on the other hand, offers you more upside, but you have to accept some limited downside risk in return. And finally, the immediate annuity. That's not really about growth at all. That's for when you have a lump sum and you just want to turn it into a guaranteed paycheck for life.
So it's that combination of potential market growth with total principal protection that makes the fixed indexed annuity, or FIA, just incredibly popular. But that promise involves some pretty complex mechanics behind the scenes. So let's break down exactly how it all works. The real engine of an FIA is how it calculates your interest. See, it's linked to an outside market index, but it doesn't just give you what the market returned. Instead, it uses a set of specific rules. You can think of them as levers to decide what slice of that index's performance actually gets credited to your account. Now, you might be asking, how can an insurance company promise that? Well, in simple terms, they take most of your money and buy super safe bonds to guarantee your principal. Then they use the interest from those bonds to buy options on the market index. And that's what gives you that potential for growth without the risk. All right, the first and most common lever you'll see is the cap. A cap is, well, it's exactly what it sounds like. It's a ceiling on your potential interest for that period. The insurance company sets a maximum rate, and even if the market has a monster year and soars way past that number, your credited interest won't go any higher than the cap. So here's how a cap plays out in the real world. Let's say the S&P 500 has a fantastic year. It's up 12%. Awesome. But if your contract has a 6% cap, you get credited a solid 6%. Now, yeah, you miss out on that extra upside, but here's the trade-off, and it's a big one. You have a 0% floor. So if the market had gone down 12% instead, you would have lost nothing. Okay, another tool they use is something called a spread. The easiest way to think about this is like a small fee that's taken directly from the index's gain. So if the index goes up by 10% and the spread is 2%, the insurance company just subtracts that 2% and credits you the rest, in this case, 8%. And the third key lever is the participation rate. This one's pretty straightforward. It just determines what percentage of the index's gain you actually get to participate in. For example, if the index is up 10% and your participation rate is 50%, you get credited 5%. It's just another way the insurers manage their risk while still giving you a piece of the market's upside. Now, this is the really powerful part. What happens after your interest is credited? This is what people call the ratchet effect. Each year, once your interest is calculated, it gets locked in. It becomes a permanent part of your new principal value, and it can never, ever be lost because of a future market downturn. It's kind of like climbing a ladder. Every step up is secure, and you can't get pushed back down. So we've got the caps, spreads, and participation rates down. But those aren't the only things at play. There are other parts of the contract that can have a huge impact on your final returns. So let's look at some of the other levers you really need to be aware of. You see, your contract isn't just a single bet. You can often split your money across different strategies. And here's a huge one. The insurance carrier can reset your caps and rates every year. That's why their history of fair renewals is so important. And of course, things like the contract's term length, any upfront bonuses they offer, and optional add-ons, called riders, can dramatically change the whole picture. Okay, pay attention, because this is probably the single most confusing thing about annuities. Your cash value is your real money. It's the amount you could actually withdraw. But an optional income rider often has a completely separate roll-up value that might grow at some guaranteed rate, like 7 or 8%. That is not your cash value. I'll say it again.
That is not your real money. It is a hypothetical number used only as a calculator to figure out your future income payments. It's so crucial to know that they are two totally different things. Okay, we've looked at all the nuts and bolts, we've waded through the jargon, so what do you actually do with all this knowledge? How do you put it into action and pick a strategy that actually lines up with your financial goals? Here's a simple 5-step framework you can follow. First, define your objective. What are you trying to do here? Is it all about safety, protected growth, something else? Second, match your timeline. Don't lock up money for 10 years if you might need it in 3. Third, diversify your strategies inside the annuity itself. Fourth, and this is a big one, research the company's history of renewal rates, not just the flashy numbers they're offering today. And finally, always, compare official illustrations from a few different companies to see how all these rules actually play out with real numbers. So we'll leave you with this question because it really gets to the heart of the entire annuity trade-off. What matters more to you? Is it the potential for that unlimited upside, capturing every last bit of a bull market run, even if that means risking losses? Or is the peace of mind that comes from a guaranteed floor, knowing your principal is absolutely safe, more valuable? Your answer to that question is really the key to figuring out if a product like this is the right fit for you.